Hey everybody, welcome back. In today's video, we're going to be talking about running your numbers. And so now we're assuming that you found a property and you've identified your buy box and you have a property in mind. So now you need to figure out, is this going to be a good deal or not? So today's video is going to get a little more in depth of numbers and math. So let's jump into it. I'm going to share with you the first rental property that I actually purchased and giving you the numbers of what it was like in the first year of that rental property. So let me pull up my handy visual aids here. Let me find my PowerPoint. Okay, here we go. So I created these slides. Hopefully you can see that. So as you can see here, I purchased this property for $150,000. Now, I said that I buy through wholesale properties because I can get them at a discount. After I did when I purchased the property, I used a hard money loan, but then I refinanced it into a conventional rate. And when the appraised value came in for that loan, it appraised just 1 month later at 167. So this was back in 2018. Late 2018, early 2019. So at the time, the value of that property was 167. It since has probably more than doubled in value based on all the appreciation that's going on today. So this shows you here the numbers that we're going to need to look at using. So again, I purchased it for 150. The value at that time was 167. The down payment that I put was $27,140.40, and then the closing costs that I had to pay was $3875.49. So my down payment plus my closing costs, my total cash invested was $31,015.89. So we're going to need to use those numbers in a calculation. So now the second slide is what are our monthly numbers. So I inherited a tenant and she was at that time paying $1,250 in rent, and I had to honor that lease. So it was $1,250 in rent for the first year. My monthly payment on my loan was, after I refinanced it into a conventional fixed rate loan, was just the principal and interest. So the P&I was $634.38 per month. The insurance was $43.96 a month. Taxes $58.26. Now, you don't pay vacancy and repairs every month, but you need to account for that in case you have a vacancy or have repairs. So you just need to budget for that. So I'm estimating in this example that 5% of the rent goes towards a vacancy and 10% of the rent goes towards repairs that you would just hold into your bank account. So then I showed on the in the brackets what it is per year for all of those expenses. So that now we're going to need these numbers to determine our one calculation that we're going to look at is our cash flow. So what is our monthly cash flow? So my next slide here is cash flow. So if you can see that, so you're going to take your rent, your monthly rent, and you're going to subtract out your principal and interest, your insurance, your taxes, taking into account vacancy and repairs. So at the end of the month, after all of that, I netted $325.90 per month in cash flow. Now again, this is just the first year. Since that time, I've been able to raise the rent and increase the cash flow. But again, we're just looking at the first year that I owned the property. So this would be how you calculate your cash flow. Take your monthly rent and then back out all of your monthly expenses. Now, if you have an HOA or a property management company, you would need to account for those as well. But There is no HOA on this property, and I do not use a property management company. I just manage the properties myself. So that would be how you calculate your monthly cash flow. So again, take your monthly rent and back out all of your expenses. If you have a mortgage on the property, the principal and interest for that, your insurance, your taxes, account for vacancy, even though I haven't had any vacancies on this property, repairs, and then if you had any HOA or any property management fees, you would back all of that out, and that would give you your monthly cash flow. And I just then calculated what it was per year. So just $325.90 times 12 gave me $3,910.80 per year. So that's one calculation that you can run to determine what your cash flow is. Now, you obviously want to buy something that has positive cash flow because that's the whole point. You don't want to buy anything to where it's negative cash flow. So you need to determine what your mortgage is going to be. So you could use a mortgage calculator. If you're not sure where interest rates are at, you can find that online. You could just type in or search like what are mortgage rates or conventional mortgage rates, investment properties. Now, the rates on investment properties are going to be higher than if you have a primary residence. If you're not sure how to look up your taxes, then you can go to the county website and you can search the address through the county tax website, the county tax assessor's site, and you can usually find any property there, and you can look up the property taxes. Also, if you know a property address, if it's actually one that's listed on the MLS, even though you may not have access to the MLS, you can usually search the address online, and you can look at like Redfin or Realtor.com, because the property, if it's listed on the MLS, it's then going to show up on Redfin or Realtor.com, and usually in those websites, it will show you what an estimated payment is for insurance and taxes, and if there's an HOA. So those are some ways that you can find out what the taxes are on the property and estimating for the insurance, and if there is an HOA. If you're going to have a property management company, then obviously you'd have to account for that on your own. So as far as calculating what your monthly payment is, you could use a mortgage calculator to determine. You can enter in the purchase price, how much you're putting down, what the loan amount is, and then what the interest rate would be. So, and then if you're doing a 30-year term, which is what I would only recommend, it doesn't make sense to do a 15-year because that just means your payment's going to be so much higher, which obviously would then eat into your cash flow to where you'd probably have negative cash flow. So now we're going to get into a little more complicated calculation, and that's if you want to know what your cash on cash return is, to determine how much am I making on my money that I've invested. Another way some people call it is the yield. So what is my yield? What is my return on my investment? What is my cash on cash return? So if you look here, now you need to more annualize the amount. So that's why earlier I had shown you what the annual costs were to determine what your cash on cash return is. So you're going to take your gross scheduled income, which is your rent per year. And when I was getting $1,250 a month, that equates to $15,000 a year. So then you're going to back out your yearly vacancy. So again, 5%, which is $750. And that gives you your gross operating income. So $14,250. Then you have to back out all your operating expenses. So your yearly insurance, your yearly taxes, and then the yearly amount allocated for repairs, which is 10% of the rent. So you follow there. So you're taking 15,000 minus 750 minus 527.52 minus 699.12 minus 1,500. So that gives you your net operating income, or your NOI. So now if that equals $11,523.36. So if you notice, the net operating income does not factor in the mortgage payment. The reason being is, in order to operate now the NOI, the net operating income, because it doesn't cost, your mortgage payment isn't considered a cost to operate the property. Now, in order to calculate your cash on cash return, because again, that's what we're factoring in here, you then need to subtract out your debt service, which is your principal and interest. So I've calculated the P&I per year, which is $7,612.56. So that gives you your annual cash flow, which we looked at earlier, $3,910.80. So that is your annual cash flow. So you figure out what your net operating income is, and then you back out your debt service, and that gives you your annual cash flow. To determine what your cash on cash return is, you take that annual cash flow and then you divide it by your cash invested. So if you recall, I put the down payment and the closing costs. The total amount of cash I invested in the property when I bought it was $31,015.89. So you're taking your annual cash flow and you're dividing it by the cash invested. And that gave me, in this example, a 12.6% cash on cash return, or that's my yield or my return on my investment. So in other words, I would be making 12.6% per year on my investment. So that's just some way, that one calculation that you can use to figure out your cash on cash return. What is your yields, or what is your percent return on the money you invested? So in essence, I invested $31,015.89, and I'm getting a 12.6% return on that money. So I'm not going to show the calculation, but if any of you have heard the rule of 72, you can basically take your percent that you're earning and divide it into 72, and that will tell you how long it will take for your investment to double. And so in other words, how much would it take to get the money back that you invested? So 12.6% divided into 72, it's like a little over 5 years, I think. So, but again, this was just, all of these numbers were based on year one of my owning and renting the property. As I mentioned, since then, I've been able to increase the rent a good amount to where my return is even more, and I have yet to have a vacancy, and I haven't had to do that many repairs on the property. So even though I'm allocating 5% for vacancy and 10% for repairs in this example, that's really not cash coming out of your account, because I haven't had a vacancy on this property, and I have had repairs, but it hasn't equated to probably 10% over each year. So that's an example of how you would run your numbers. I know that's kind of really brief and kind of rushed and maybe a little in-depth, but take the time to pause the video or go back and watch it and just figure out how I got those numbers, how I calculated that to determine your cash on cash return and your cash flow, your monthly cash flow, because those two numbers, in my opinion, are the things I look at. Now, there's a lot of other different calculations you can look at. Some people want to know what your cap rate is, and I'm not going to get into that right now, but basically you're taking your NOI or your net operating income and you're dividing it by the value of the property. So in that example, it would be your net operating income of $11,523.36 divided by the value, which at the time it was $167, and that would tell you what your cap rate is. That's just another calculation to compare properties. But again, I'm not going to get into that in this video. So hopefully that gives you some idea of how to run your numbers and how to figure out what your expenses are going to be. Again, you need to factor in your taxes, your insurance, if there's an HOA, and if you have a property management company. Factor in vacancy and repairs, and then you need to look at all of that in addition to what your mortgage payment is going to be, the principal and interest, because all of that is going to be based on whether or not that property is going to cash flow. Obviously, depends upon the market rent, the area market rent for that property, and I'll get into that in another video, but right now I just want to show how you run your numbers, and so you can use that as a starting point to figure out whether or not these properties are going to cash flow, and if it makes sense to make offers on the property. And if it doesn't make sense on what the asking price is, then you need to figure out, okay, at what price point am I cash flowing? At what does the rent need to be in order for me to cash flow? Or what is the interest rate? How is the interest rate going to affect my payments? What is the loan amount? There's so many different variables that you need to consider and understand. So make sure that you're looking at all those different scenarios. If it doesn't make sense at a certain price point, then at what price point does it make sense to buy that property? Just because the seller is asking one price doesn't mean that's what you have to pay. Maybe you can offer a lower price and maybe your offer will get accepted. You don't know unless you actually try and make that offer. But ultimately, you need to run your numbers so you know what you can afford and what numbers work for your calculations and for your cash flow, and based on what return you're wanting. So anyway, that video was a little more in-depth and math related than the others have been. But again, if you need to go back and watch the video, pause it, stop, try running your own numbers. Look up at a property and try to figure out what the rent is going to be. Try to figure out what the taxes and the insurance are, and figure out what your monthly payment would be based on a loan amount and an interest rate. And then figure out, what is my monthly cash flow? What is my cash on cash return? And you need to start doing that to get in the practice and the habit of analyzing properties, because that's the only way you're going to know whether or not it makes sense on a great deal and if you should make an offer on a property. So that's going to wrap up part 3 of this series. So next videos we'll get into part 4, and we will talk about a little more specifics on real estate investing, and I will try and discuss and share some of the concerns and questions you may have as far as actually investing and how to manage the property once you actually get a property under contract, and once you actually have a property that you've closed on. So thanks everybody for sticking with me on this video. We'll see you on the next series, and we will wrap up part 4, which will be the last part of this series of chalkboard financing. Thanks. We'll talk to you guys on the next video.